There's a number on the United States government's balance sheet that most people have never heard of, and it hasn't changed since 1973. $42.22. That's still the official price the Treasury uses to value every ounce of gold it owns. Not $4,000, not $5,000, $42.22. The actual market price trades more than 90 times higher. And for 20 straight months, one country has been buying that same metal on a streak longer than anything since 2015, China. In June, its central bank added the largest single month haul since 2023. Nobody in Washington has explained why gold sits frozen at a Nixon-era price while China keeps loading up. But between that old accounting rule, a research paper the Federal Reserve quietly published last August, and a new Fed chairman who has already promised sweeping changes to monetary policy, there's a mechanism that could reprice gold by an order of magnitude most investors haven't considered. This video walks through how that mechanism works, why the last week of July matters to people watching this closely, and where the number 38,000 actually comes from. Start with a decision Franklin Roosevelt made in 1934. At the time, the government valued gold at $20.67 an ounce. In the middle of the Depression, Roosevelt signed the Gold Reserve Act, pulled every ounce of monetary gold onto the Treasury's books, and declared a new price $35 an ounce. That single decision devalued the dollar by 59% against gold, and the government's gold holdings jumped in value without a single new coin being mined. The price held for almost 4 decades. In August 1971, Nixon cut the last tie between the dollar and gold, ending the ability of foreign governments to redeem dollars for bullion. A year later, the statutory price moved to $38. In 1973, it moved once more to $42.22, and it has sat there for over 50 years while the market price climbed from $35 to over $4,000. The U.S. has revalued its gold reserves by government decree twice within a single generation. That's documented policy, not theory. In August 2025, Federal Reserve staff published a paper called Official Reserve Revaluations, the International Experience. It studied 5 countries that have revalued their gold holdings and modeled how the U.S. could do the same, moving its books from $42 towards something closer to the market price. The Fed's own researchers weren't asking whether this was possible. They were studying how other countries already did it. The U.S. holds around 261 million troy ounces of gold. At $42.22, that's worth just over $11 billion on paper. At close to $4,000 an ounce, the same gold is worth more than $1 trillion. Changing a number in a ledger without selling a single bar would add over $1 trillion in recognized value to the government's balance sheet. Analysts at Crescat Capital have argued that historical revaluation ratios applied to today's monetary base imply a price range between $25,000 and $55,000 an ounce. Luke Groman's framework lands in the high 30,000s. James Rickards, working from the U.S. M1 money supply and a partial gold backing ratio, once arrived at a figure north of 27,000. None of these are predictions. They're different math applied to the same question. What happens to gold if the government ever needs it to matter on the balance sheet again? Gold bull markets tend to cluster around 3 things happening at once: negative real interest rates, a late-stage business cycle, and a currency under pressure from debt or trade imbalances. All 3 showed up together in the 1970s, which is a large part of why gold went from $35 to over $800 in a decade. A milder version showed up in the 2000s. Right now, several of those conditions are visible again. A Fed still trying to get inflation back to target years after it broke through, a debt load bigger than anything in the post-war era, and a new Fed chairman openly uncomfortable with the framework that got policymakers here. That doesn't guarantee a repeat of the 1970s. Cycles don't repeat exactly, but the ingredients look familiar enough that people who study this seriously, not just gold sellers, are paying attention. China fits into this directly. According to China's State Administration of Foreign Exchange, the People's Bank of China added just under 15 tons of gold in June, the largest single month purchase since 2023, extending a buying streak to 20 consecutive months, the longest since at least 2015. Gold still makes up less than 10% of China's foreign reserves. The U.S. holds roughly 70% of its reserves in gold. Germany is similar. China has a long way to go if it wants parity, and the data says it intends to close that gap. World Gold Council research, using Swiss refinery flows and London OTC data, found that global central bank gold purchases accelerated in the first quarter of this year, and that Chinese net gold imports nearly tripled quarter over quarter. This isn't a short-term hedge. It's a multi-year shift away from a system anchored to the dollar. Central banks don't buy gold for a trade. They buy it as insurance against a currency they no longer trust to hold value across decades. This kind of buying has historically clustered around rising government debt, persistent inflation, and doubts about whether the reserve currency issuer can manage its own balance sheet. The U.S. is currently carrying over $38 trillion in debt, and the math on servicing it gets harder every year. Rates stay elevated. A government facing that arithmetic, sitting on $1 trillion gap between its official and market gold value, whose own central bank just studied how other countries close that exact gap, isn't a conspiracy theory. It's just what the data says. There's a psychological piece to this too. Picture two fictional portfolio managers, one in New York, one in Shanghai, looking at the same spreadsheet of reserves. The New York manager has spent his career assuming the dollar is just the water everyone swims in, so $1 trillion gap on a gold ledger reads as trivia. The Shanghai manager has spent the last 2 decades watching sanctions freeze foreign reserves overnight and currencies get devalued by decree. To him, that same spreadsheet is a checklist. That's not a directive from some ministry. It's the ordinary human habit of weighing risks you've lived through more heavily than risks you've only read about. Reserve managers in Beijing lived through a currency shock in the 1990s and watched Russia's dollar reserves get frozen in 2022. Reserve managers in Washington have never had to operate without the privilege of printing the world's reserve currency. Neither side is wrong. They're just working from different histories, and that gap may explain more of the current gold market than most coverage admits. Being the reserve currency lets the U.S. borrow more cheaply than it otherwise could, because foreigners are always willing to hold dollars. Economists call this the exorbitant privilege, and it isn't free. Supplying the world with enough dollars to trade and save and requires running persistent trade deficits year after year. Robert Triffin described this back in the 1960s. Supplying the world's reserve currency slowly undermines confidence in that same currency because it forces the issuing country into bigger and bigger imbalances. Gold has functioned for thousands of years as the one reserve asset that sits outside any single country's ledger, the one thing that can't be frozen or devalued by someone else's decision. That's why central banks, not retail traders, are driving this wave of buying. They're hedging against the system they built and still depend on. If this kind of breakdown is useful to you, subscribing means you catch the next one, and a like helps this reach people trying to actually understand markets instead of just reacting to headlines. I'd also like to know what you think. Is a formal gold revaluation something a modern Treasury would ever actually attempt, or is admitting the dollar needs that kind of backstop too costly politically for any administration to try? Back to the story. In May, Kevin Warsh, a former Fed governor who left the board in 2011, returned to Washington. Trump nominated him. The Senate confirmed him by the narrowest margin for a Fed chair in history, and he was sworn in as the 17th chairman of the Federal Reserve. He's also the first Fed chair widely described as pro-crypto, which says something about how this Fed may approach hard assets and monetary credibility compared to its predecessors. In his first congressional testimony this month, Warsh said inflation remains too high and has placed an undue burden on households. He said that in his first 6 weeks, the Fed had already set off what he called a sea change across at least 5 dimensions of policy, and he specifically criticized the flexible inflation targeting framework adopted in 2020 as a mistake that let the Fed for a little more inflation and end up with a lot more. Every major gold revaluation in U.S. history required a leader willing to break from institutional habit and make an unconventional call. Roosevelt did it during a crisis of confidence in the currency. Nixon did it under similar pressure. A Fed chair openly promising regime change, skeptical of the last decade's framework, and comfortable with hard and alternative assets is exactly the kind of person who could plausibly be in that room if the conversation ever moved from research paper to policy. That doesn't mean it will happen. It means the personnel, for the first time in decades, line up with the idea, which brings us to the calendar. The FOMC meets July 28 and 29, with the rate decision landing at 2 p.m. Eastern on the 29th, followed by Warsh's press conference. Going in, the federal funds rate sits at 3.5 to 3.75%, unchanged since December. Markets are split. A softer than expected jobs report pulled some traders toward expecting no change, while hawkish comments from other Fed officials, worried about repeating past delays, pushed odds back toward a possible quarter-point hike. The days around month-end options expiries and Fed decisions have historically produced some of the sharpest short-term swings in precious metals as large positions unwind. Whatever the Fed decides, the language Warsh uses afterward about inflation, the dollar, and the Fed's own reserve assets will get parsed line by the same institutional buyers who've been accumulating gold for 20 straight months. It's worth being precise about what's known versus what isn't. We know the statutory gold price hasn't moved since 1973. We know Fed staff studied international gold revaluation case studies last year. We know China has bought gold every month for nearly 2 years at an accelerating pace and still holds a small fraction of its reserves in the metal compared to Western central banks. We know the current Fed chairman has promised sweeping change to how the Fed handles inflation and credibility. What we don't know is whether any of this converges into an actual decision to revalue gold. The evidence points to growing structural pressure toward that outcome over time. It doesn't point to a date, a number, or a specific trigger. Plenty of economists would argue the political cost of admitting the dollar needs that kind of backstop is too high for any administration to accept outright, and that if this ever happens, it happens quietly, framed as a technical adjustment rather than a headline. A gold revaluation was never really about gold. In 1934, it gave the government room to fund recovery programs without new taxes or debt. In 1971 and 1972, it acknowledged that the old system couldn't hold under new obligations. The same pressure exists today, debt growing faster than the economy, a Fed chair questioning the last 2 decades' framework, and a rival power quietly building a reserve position that no longer assumes the dollar stays dominant forever. Gold each time was the release valve a monetary system reached for when the old arithmetic stopped working. The Fed and the People's Bank of China are both, in their own ways, already positioning for a world where gold matters more than it has in 50 years, whether that shows up at the July meeting or much later. That's where the number 38,000 comes from. Not a prediction. A pattern in the accounting of the 2 largest economies on Earth for anyone paying attention to it. If you want the next update when the Fed meets, subscribe.